What's good, YouTube? It's your boy Charles Enoch, and you know we're back with another Invest in Myself episode. So I had somebody reach out to me and they asked me how they could get rid of their PMI on their mortgage to free up that cash flow. Now, for those that don't know what PMI is, it stands for private mortgage insurance. And this is usually added to your loan if you don't put down 20% or more. It's pretty much a type of insurance for the bank since you're not putting the traditional 20% down. So, for example, if you're buying a $200,000 house, 20% of that will be $40,000. But let's say you only put $20,000 down, which would be 10%. Then the bank will put PMI on your mortgage until you pay down at least 20%, until you have paid down 20% of what the house is worth. So with that being said, with this scenario, we will actually use a credit card as our debt weapon to pay off the PMI to free up the cash flow, and then we would pay the credit card off with minimal interest applied. But before we head to the whiteboard, go ahead, smash that like button for me. Help a brother out. Make that thing turn blue. Also, if you have not subscribed to the channel, go ahead, take time, hit that subscribe button for me. I always appreciate the people that take time to do that. It really helps me reach a higher audience base. Also, if this information is helpful, go ahead, take time to write a little comment like, hey, this information was awesome. I learned something. I really do like reading the comments. All right, without further ado, let's get on this whiteboard and crunch these numbers. All right, so we're at the whiteboard. We're gonna get straight into it here. So we have Robert Jones. Income is $4,700. Expenses is $2,828. Cash flow is $1,872. Now, the debt that we're trying to pay off, remember, is that PMI, private mortgage insurance. So the private mortgage insurance is $13,000 Mr. Jones needs to pay off so the PMI can be released off of the mortgage. So the PMI monthly is $240, which is rolled up into his mortgage. When we pay that off, $240 of his expenses will be freed up, which will make his cash flow go up $240. Now, what we're going to be doing here, Mr. Jones, he has a Bank of America credit card that's $17,000 and it's a 13% interest rate. What Mr. Jones is going to do here, he has a convenience check. And the terms of the convenience check is 3% fee for using the convenience check, and then he would have 12 months to pay off the convenience check with no interest. And for those that don't know what a convenience check is, it's one of those checks that you get in the mail that the credit card companies, they send to you, where if you use the check, it's kind of like a balance transfer. If you use the check, they're going to charge some type of fee, and they usually cut a deal with you where it's 0% interest for 12 months, maybe even 18 months, if you use the convenience check and take money out of your credit card. So Mr. Jones could actually pay off his PMI just based on his assets. He has an investment stock that he does not want to liquidate though, because that investment stock is growing him more money. So what we teach with Velocity Banking, we don't want to touch our investments that's giving us money, that's giving us a return. We rather use the bank's money to invest, to defensively invest, to pay off the PMI, and then we would pay the bank back. But we wouldn't be touching none of our investments to pay off something else. All right, so I tried a different way to break this one down. I think it would be a more simpler way. So we're going to see what Mr. Jones needs to do to get rid of that PMI and to pay his credit card back. So we're going to go step by step. So we have step one. He is going to use his Bank of America card that has $17,000 limit on it, and write a convenience check to himself for $13,000, he will be charged 3%. So he'll be charged an extra $390 on that credit card. Now the balance on the card, it will equal $13,390, and he would have 12 months to pay off the balance with 0% interest accruing. Now on step 2, once you write that convenience check and it comes into your account and you see that $13,000, what Mr. Jones is going to do, he's going to use $13,000 of that money in his checking account, because he wrote a check to himself, and he will apply it towards the principal of his rental. Once he applies that towards the rental, it will eliminate the PMI and free up $240 of cash flow. Now, one thing to note with step 2, you are still paying your regular mortgage payment for that month. You're applying the extra $13,000 onto the principal to pay off the PMI. So you're doing a payment, your monthly mortgage payment, which would be part of your expenses, and all that extra money goes straight towards the principal to delete that PMI. All right, so now that we have that understanding, we're on step 3. So Mr. Jones's cash flow is $1,872, which we see right there. Then we're going to add the $240 that we got because we deleted the PMI or eliminated the PMI from the mortgage. So now the cash flow is $2,112 every single month. So step 4, we're putting all of your cash flow onto the credit card each month. So once you have your income coming in, paying off your expenses, your cash flow is at $2,112. You shove that onto your credit card each month. Now, one thing to note, when you're doing a convenience check and you write that to yourself and then that money gets applied towards your credit card, you do not want to use your credit card, swipe your credit card to buy anything. Because once you do, then interest actually applies onto whatever you paid. So for example, if you went to McDonald's and bought a Happy Meal for $5, then you have to pay interest on that $5. Now, one thing that people think that they can do is just swipe that card and just pay that $5 off and go back to the 0 interest. It does not work like that. The bank strategically will say that you have to pay that $13,390 off first to get to that $5 that you paid on the card that is charging you interest. So moral is, do not use the credit card for anything. You're just shoving all your cash flow onto the credit card. Now, step 5, we're going to see how long it's going to take to pay off the credit card with the new cash flow. So we have the $13,390 divided by $2,122. This will equal 6.3. And 6.3 is in months. So 6.3 months, it will take us a little over 6 months to pay off the credit card with our new cash flow. Now for step 6, you have paid off $13,000 in 6 months, and you will only charge $390 in interest, which is the convenience check fee for writing it for yourself. So I believe these 7 steps are very simple in regards to having everybody understand what is going on. And by using this method, all we did was convert that $13,000 from amortized interest onto simple interest. So we use the convenience check to write us $13,000 into our bank account. $13,000 was applied to your credit card. We had a 12-month 0% interest. That $13,000 you put all on principal of your mortgage, which reduces that PMI. You don't have it anymore, which freed up the cash flow. Now that $13,390, you're paying that in simple interest. And with the 0% interest, all the money that you put in there applies towards the debt. As opposed to if you just put onto your mortgage and you just kept paying it, it's going to be amortized and it's going to take you a longer time to pay that $13,000 off if you kept it rolled up into that loan. Now, one thing to note, that since you have the 0% interest for the whole 12 months, you necessarily do not have to put all your cash flow onto the credit card. Because remember, if you use your credit card, that means interest will start accruing. So usually what I do, I pay the minimum on whatever the payment is for the credit card. Because we did our math and we know it's going to take 6.3 months to pay it all off. So I would pay the minimum. Let's say the minimum is $100 that you have to put on every month. All the rest of your cash flow, you can actually save that cash flow in a high savings bank account like Ally or something. So then you're at least getting some money on top of that money, and that money you can actually take out just in case for emergencies and different things like that. So the way that I usually do it, I'll pay the minimum payment until, let's say, month 7, when I have enough money saved up into my savings account that's actually growing just a tad bit of interest on there by having it in those high yield savings account. And then in month 7, I pay it all off. There's not no interest accruing because you have 12 months to pay it off. So that's a way where I personally wouldn't put all of it onto the credit card, because then you can't really use the credit card. Just pay the minimum payment, keep it into your account. Month 7 comes along, boom, pay it all off. Or since you have 12 months, you can keep it there. Maybe in month 10, you want to pay it all off, So these are kind of basic steps on how we use the bank's money to pay off the PMI to increase our cash flow, and then we pay the bank back. They only charge us $390 in interest. And here's the key thing. Mr. Jones had investment stock. Let's say he had it in Tesla and things like that were making a lot of money, and it's just going up so fast. He doesn't want to liquidate that. So that's still staying there, gaining him more money. So again, this is a strategic way to be using other people's money and not having to liquidate your assets, because you want your assets to keep growing. So hopefully this makes sense. Definitely leave a comment if you like this step-by-step format, if it's a little easier for you. And again, if this was very helpful, remember to hit that like button, make that thing turn blue. And if you're new to the channel, go ahead, take time, hit that subscribe button for me. And like always, hopefully you guys have a good weekend. Peace out.